Evening, everyone. My name is Simon Mishevich.
And my name is Louise Mishevich.
And it is nearing January. Yes. But my big question is, why are you watching this show when you should be doing your tax return? I mean,
because you've already done it, obviously.
Yeah. Clearly, people should do it.
It's done, Simon. It's done.
It's very done in my eyes. I'm just going to check on my live stream to make sure this is going through. It does say I'm live. So if you can give me a shout out to say you can see me, it looks like people can, so that's good. Tonight, Louise, we've got a very special guest, haven't we?
We have, and it's not Santa.
It's not Santa, no. It's someone called Jack in the Beanstalk. No, it's called Jake Illis.
It is pantomime season.
It is pantomime. Oh, no, it's not. And he's not behind me, is he? He's not behind me.
Sorry, everyone.
So we're talking about capital allowances. And if you think capital allowances are quite complex, there you go.
And that's not an empty page book either.
It is a bit of a beast of a book. So Jake Illis will be joining us later on in this show. Yeah, so he's our first guest. So it's a bit of a this year we are planning on having guest speakers coming on to talk about their subjects, of course. And it's obviously good to help you build your wealth whilst reducing your tax, whether that's business or indeed if that's in property as well. So we'll be doing those. But obviously this is a live session. So if you have questions, then feel free to ask those questions. And it might just calm my nerves with my guest speaker and technology that was brutally massacred last month when we was in Spain. Any comments?
I dare not.
What's your views on tax returns with not the deadline extension? But why don't you share your thoughts?
Tax returns, partnership tax returns, and trust returns. So we are but just 10 or so days away really from the end of what should be the usual deadline for both filing a tax return if you're a personal tax return filer and paying your taxes or whatever's left to pay at this point in the year if you've already made payments on account earlier. So the world is a little mad. HMRC systems look like so far they're holding up. So they haven't fallen over. They aren't causing mayhem in terms of payments that you're trying to make or perhaps filings. Not that I've heard anyway. All is good and all is progressing. But HMRC do often say the last 7 days, which really will commence on Monday next week, can be quite a tricky 7 days with the technology simply because so many people attempt to A, file their returns and B, pay their tax in that period. And of course, HMRC systems get a little bit flaky, understandable from the sheer volume and weight of things happening during that period. Think trying to book your COVID booster with everybody else when the Omicron variant first landed is probably the best analogy I can come up with at this point. But so far, so good. And if you've already done it, well done you. Well done for getting it all done and sorted. Just a word to the wise, if you haven't yet filed, because, hey, HMRC have said we can file in February, it's okay. Yes, they have, but that hasn't changed the filing deadline or rather payment deadline for your personal taxes. They're still due by the 31st of Jan. And of course, in order to know what you've got to pay, you've probably got to do your tax return to work out what you've got to pay. So you might as well get them filed, and that's a really good place to be. Filing after the end of January, obviously you won't pick up the late filing penalty as long as you file before the end of Feb, but paying late, you'll start picking up late payment interest every single day from and including the 1st of Feb. So do get those payments done if you can.
And if you're American, you've got something else to look forward to because it's now 1040 tax season as well.
Hey!
So the IRS have officially opened their doors. But if you have got a tax return to file to the IRS, don't expect your refunds to be anytime soon. They have released a statement to say that they're not likely to get these done until March, but I rather suspect they're still working on 2021. So if you are American, you've got to file their 1040 tax returns, then beware. And equally, don't forget, if you're Spanish, your tax return is due soon as well. So what we're going to do, as ever, Jake is coming purposely a little bit later on. So what we want to do.
Arriving fashionably late, I see.
Yes. Let's hope he's going to be late as opposed to not here at all.
Sure,
we have been in communication. All the thing that will let us down is technology. So we'll wait and see.
Oh, no, it won't. Sorry. couldn't help myself.
Yeah.
Sorry.
So what we're going to do, as ever, is we will take your questions live. There's been people that have registered before, so they've posed their questions, so we will get to those rather drastically quickly, and then we'll get to yours as well. But if it's connected, then we'll answer your question at the same time. So feel free to say hi on the comments box below, and we'll say hi back.
Hi.
So let's go with the first question. I'm going to test this out. You know what I'm like with my technology.
Simon loves his tech. Here we
so
go.
This is where I can go to show. There you go. This is where it covers us. We did this in Spain, and it covered us. It's almost as though we're peering over the question set. The settings of the camera wasn't always a good too place good. To be. Now, go on, say that. Sheila.
Hello,
I didn't want to embarrass myself. Sheila's asked a question, so we will get to her question later on. So good evening.
Yes, you have. Hi. Looking at your question earlier.
We've also got AP Chartered Accountants with us.
Hello.
So that's Asma. So good evening, Asma.
Hi, Asma.
So let's talk about this question. So Bobu, can I lease a car through an SPV for tax efficiency? I have a HMO earning 2k net. Can I lease a car, increase expenses, reduce liability at the end of the year? And I would always say that cars and having a company car, especially if it's lethal, make sure you get a safe car. You know, if it's lethal, don't get one of those. Your insurance will go up.
All of that jazz.
Yeah, definitely. Don't be getting those Flintstone cars where you've got to run with it. It looks quite funny.
Ruins your shoe leather.
Yeah, absolutely, especially in nice bootins. So where was I? Yes. So we're talking about SPVs and company cars. If you've got a petrol or diesel car, trust me, guys, the benefit in kind charges is excessive. You have to look at the CO2 emissions. You'll have an income tax liability. Your employer, which is your limited company, will also have a 13.8% employees' national insurance contributions on that value.
Insurance, happy days.
So it's never worth it if I'm touching on. However, electric cars could be quite useful. A couple of reasons for that is there's very little, at the minute, there's no benefit in kind charge as far as I know.
Certain ones.
But there are going to be introducing benefit in kind charges even for electric cars. And I rather suspect, to be honest, all of those people that have been thinking electric cars are the way future to get these tax breaks. Once the population is saturated with electric cars, that's when HMRC say, well, everyone's got them now, so we can retract the incentive.
Well, we're already starting to see that.
Yeah.
In terms of the incentive you were getting, for example, to install an electric charge point. There were lots of incentives initially in terms of getting tax relief on the expense of doing so. That's now starting to fall away. So I agree, Simon, we're going to see a reduction soon.
If you don't mind not rubbing against the desk, it's not very BBC. I've got to be honest with you. It's going straight through that microphone. Not very BBC.
We're not BBC here.
No, we are. Yes, I've been trying to get a job there for a long time. Right. So moving on. I don't think it is the best thing to do, even if you do earn 2k net, unless you buy an electric car. But a great question all the same.
The treatment, though, is slightly different if you were purchasing it in your own name and your property rental income is in your own name as well. And I won't go into lots of detail now, but that's a slightly different scenario. Doesn't necessarily trigger the same types of tax. But what we tend to find for a lot of our clients is we do a lot of analysis around, are you better to have the company pay for the vehicle, or actually are you better to have the company pay for the mileage? Because in most cases, up to the first 10,000 miles per year, you could be claiming 45 pence a mile as an expense to your company. So often we find, I would say more often than not, it's better to claim the mileage than have the business pay for the vehicle. But the detail is always interesting to get to.
I mean, one thing I would say, I'm just going to try and send this if I can get to. Oh, crikey! It does say I was just trying to invite someone, a guest. So I think they've already got this, but I'm just going to send this to Jake just in case. So Jake, if you are watching this, I'll let you know that this invite is going through to you now. In regards to cars, though, one thing I would say about cars is that they are expensive. And I think that people sometimes they make an emotional decision because it's a fancy car. I get that, But sometimes I often think that people also look at the tax and try and say, well, it's tax efficient.
Yes.
So I surely should do it because I get a massive tax write-off. What you've got to remember is you've got to...
Don't let the tax tail wag the dog. Gosh,
yeah,
my teeth were not in then.
Exactly. So so you have to be careful. I'm going to go to the next question because I know that Jake might be trying to click into the link. So I'm just going to find out from this question first. So Bobo's asked another question.
Hello again, Bobo.
And this time around, the question is around this. So it's asked, what's the best structure for title splitting, e.g. buying a freehold block of flats, creating subleases, and what should I consider? Talk to the audience about what we did, because that's very similar to this, right?
So we have done that kind of thing as well. And one of the first things that we certainly learned was that you don't necessarily have to title split. It depends why and what you're going to do with the building once you've got it and why you've got it. Actually, if you're buying it to retain it and make, fantastic income from it, why are you going through the effort of splitting? You don't necessarily need to do that to make the income. So be very careful as to why you're splitting and what it's really going to give you. If you are identifying that splitting is the very best solution, perhaps because you're going to sell off some of the units, maybe not yet, but in the very near future, but you don't want to sell them all, then think about, in the majority of cases, I would say, and this all depends as well on the legalities of the particular purchase you're going through, but more often than not, start with buying it in the structure or the company name or whatever it is that you're going to buy it inside of. Buy it in that company in which you would probably keep the leaseholds, because it can be much more tax efficient to then segregate the freehold away from the leaseholds rather than the other way around. And most legal specialists will tell you when you are looking at title splitting that you cannot keep the leaseholds and the freehold in the same ownership business or structure. They must be separated. That's the whole point of why you're splitting. So not only are you splitting the asset into freehold portion and leasehold portions, you need to also split the ownership across different asset owners as well.
Yeah. So still waiting for Jake to come back to say if he's able to get in, because I can't see anything going.
He's not knocking at the door.
He's not knocking on the door. He's not. So okay, so hopefully that's answered that question from Bobo. I'm going to go a different question now. So this is it. So let's show this question. And this is from David.
Hello, David.
I'm interested to know if residential property is best for someone starting out in property investing or is commercial property. And the big thing I would say about this is that I believe that commercial property is very much underrated by many. And the reason for that is if you look on the internet, you will find people delivering property courses about residential property, but not very many talk about commercial property. And that's because there's lots and lots of houses, there's lots and lots of commercial buildings, but people sway towards residential because it's something that is a known quantity.
And most people have lived in a home, so they understand it better.
Yeah, exactly. So
I would say that's a really strong reason why a lot of our clients first dip their toe in property, or when they first dipped their toe, it would have been in residential property rather than in commercial. It's a lovely question you raise, actually, though, David, because to a degree, it's down to where you feel the most confident. A, you're going to make the money you wish to make as a return, and B, that you have the assurances and safeguards around the risks that you identify could be applicable to your situation. There are lots of pros and cons to each, never mind the tax points. One of the reasons a lot of our clients who do very much focus on commercial say they love it is because it's almost a kind of buy and leave, in the sense that once you have a tenant in, often the lease that you have is a fully repairing lease. In other words, the boiler goes, a window breaks, something goes wrong, it is the tenant's responsibility, and it must be from the tenant's pocket that is corrected. And then at the end of the tenancy, when they walk away, you go and survey it and basically bill them for any expenses that need to be incurred to bring it back to the standard it was at when you first let it to them. So commercial leases tend to be a much more kind of almost lock and leave. You buy it, you lock it in, and then you leave it alone once the tenant's in.
Yeah. And just on that side as well, you won't get people phoning in at 2:00 in the morning when they've had too much drink. Lost the keys, or someone's eaten their sausage roll, which we've had before. And they won't have the bickering into the communal spaces, which again we've had because one person's been too noisy or just not being too pleasant to the other ones. And you have to then become, in a HMO, I think you've got to be a counsellor. I'm not sure what you're looking at me like that for. But
I don't see Simon as a counsellor.
Oh, thanks. But I think there's a lot less noise with commercial properties than residential properties, if I'm totally honest with you. So I think it's certainly worth you thinking about that.
Great question.
Yeah, and anyone starting. I mean, the thing for me as well is when it comes to those types of properties, I think it's all about knowledge. I don't think it's one risky than the other one, if I'm totally honest with you. If you go for the wrong kind of properties, then I think you could get the wrong kind of assets, but you could get the wrong type of assets in whatever you do. Cryptocurrency, we've seen go boom and pop. You've seen that in cars and gold and silver. So, don't be thinking that commercial property just because it's something you don't know anything about. Equip yourself with good knowledge, and then that way should help you out with that.
Exactly.
Just going to go on to a different question. Still trying to get Jake onto the show, so I shall bear with me on that one. I talked about capital allowances already on cars, so I won't go on to that. Let's just go through this question. This is from Ian, and then I'll go on to some of the questions that you've set live. So that's quite good that you're doing that already, guys. So please do post your questions to us, and we'll come to those as well. So this question is from Ian, said, if we run... and Jake's come and join us as well. Here's Jake. I can see him. So we'll bring Jake in a second. Jake can hear us, I'm sure. I'm going to bring you on in a second, Jake.
Waiting in the wings like a good pantomime.
The technology has worked. Okay, I have been sweating, Jake, for the last 3 hours. I've lost about 5 stone, so it's been quite good just for that. Ian has asked, if we run, I've just repeated this, by the way, if we run a limited company already and want to buy a property through it using proceeds from a personal property sale, is this possible? I mean, all you're doing really is getting money from the property that you've sold in your name. You will have capital gains tax, so I'm going to ignore that. But you've got a sum of money, and what you're doing is setting up a limited company for £1, £2, whatever, £100, and then the rest of it you can loan to the limited company. Why is it better to set up a company with a loan rather than capital, Louise?
Well, one of the best reasons to lend a company money is that it is a loan. And ultimately, at some point, once the business can afford to pay you back, you can have that money back tax-free. Happy days. It also keeps the cash more liquid, which I know sounds a really ridiculous thing, because if you're locking it up in a property, then of course it's not liquid. But at some point, it's going to be hopefully generating enough money to get some of that lovely hard-earned cash you've thrown at it and in it back. Now, this particular question, though, Ian asks about who already has a company, and it sounds, I don't know whether that company is already doing property stuff or whether it's doing something completely different. You can, of course, have a company do multiple things. One of the big points that we do talk about with our clients repeatedly, though, and it's nothing to do with tax, is do you really want all your eggs in one basket? So if something were to go wrong with the property or perhaps with the current business that's running inside that company, could it take everything down with it? The answer is, of course, yes. So do think carefully. To Simon's point, it can be very straightforward to set up a suitable, purpose-built company for exactly what you want it to do. And yes, there might be some extra costs in running it as a separate company. And I'm really keen, for example, that our clients don't set up too many companies. They don't need to be a Richard Branson to make everything work beautifully in terms of the string of companies he has. But do think carefully about, are there reasons other than tax that it might be sensible to perhaps not have everything all in the same place?
One other thing to finish off, just before we do finish off, is if you have a direct loan account in the limited company, then you can charge its interest. And depending on how much you have taxable earnings, you can get tax-free interest from that company. And the company can write off that interest against its profits, therefore pay less tax. So it's a great way of thinking about that. But let's get to Jake, because Jake has been sitting there. He's like a bull at a gate. He's ready. So I'm going to test this system to see if you can bring us on. So
hooray!
Jake, can you hear us?
I can. Can you hear me?
Wow, this technology is working. Now, what's happened, interesting enough, with this screen, It's there we go. That's much better. Whew, I was going to panic then, Jake.
It was Jake and a YouTube cushion. That was it.
Oh, it was, yeah. That's right. Let's do that again, because that YouTube channel. Look at that. Look at that YouTube channel. Look at that. Here we go.
Is that an extreme close-up? That is it.
Exactly.
It could be. It could be worse, Jake. It could be worse. So, Jake, thank you ever so much for joining us tonight. Why don't you introduce yourself to the audience? Obviously, they know your name, but your company, what you do.
Yeah, I'm Jake Isles. I'm the owner of Six Forward Limited. I've been involved in capital allowances since 2007. Our company work exclusively with accountancy practices like yours, Simon. Yeah, we do a bit of writing of books as well. I run a sort of multi-skilled team of 12 professionals, offer a full service in the capital allowances space only. As a team, we analyse about £1 billion of commercial property every year. And we sometimes get to write articles and write books and present and speak accordingly, like this. Most of my work comes from accountants, solicitors, and agents, and also property investors from time to time. But most of the advice we offer is on transactions, buying and selling, and also for fit out and refurbs, really. So that's our main speciality. Maybe do you want me to introduce capital allowances in general, or are you happy? I guess you're...
Well, no, I think we're going to do that because there's a bunch of questions that people have set, and I've also done some research on Google to find the most common questions, and I'm actually going to go really nice and gentle with you tonight. One thing I've just picked up on, I've been calling you Illis for about 5 years.
Honestly, Jake, what can I say?
I mean, you've been calling me.
I'll be called worse, so you're right.
Yeah. So let's get started with the questions, and this is. Let me just go on to this. So
we've got a new piece of technology, Jake.
Zip it. This is my show. right. So Mr. Google has asked, "What are capital allowances?" Jake.
Oh, right. Okay. From the top, then I suppose capital allowances are sort of given for any capital expenditure you make. As a company or as an individual. So I heard you just talking about buying cars and buying equipment, but also when you buy commercial property. So the allowance itself is a tax incentive for the investment to reduce any taxable profits you make, whether you run your company or your partnership as a trade, a property business, or you have a finished holiday let business. And the reason why I explain about those three things, maybe we might have a few questions about that a bit later. So if you're buying, building, refurbing, or fitting out any commercial property, then the incentive's there for you to reduce your taxable profits as you become profitable, or if indeed you're already profitable because you already run a business with property in them. So the main points are for capital allowances are you have to own a company. The asset must be owned by the company or by the individual. You must be carrying out a trade, and the expenditure must qualify. You can't hold the asset in a pension, can't be part of a charity, can't be held in a public body. And interestingly, maybe for some of the developers out there, you can't have it for developers generally because they hold their properties as trade in stock. But there are some nuances around capital allowances that could be very, very useful, particularly around sort of types of land relief. The allowances are not given automatically. So you must claim them in your tax return, either your CT 600 as a company or your SA 100 as an individual. There's no time limit generally, as long as the asset is still owned and is still being used in your trade.
Perfect answer.
So the way I sometimes describe it for simplicity, I guess, Jake, to our clients, is that it's an extra, think of it almost like an extra receipted expense that you can access to help minimise your tax. And I know that's a very oversimplified perspective. No. Is that a fair comment to make for someone first trying to get their head around capital allowances?
Yeah, I think it's a useful cash flow consideration. So when you make a big investment, then you're not always going to be profitable. So it'd be nice to see a return on that investment. Yes. So maybe you could use the allowances and the benefits as a means of running a loss, and or there's no taxes to pay going forward, or you just cash flow your mortgage transactions, for example, might be a nice way of paying your mortgage transactions in a simple way. So.
Okay, lovely. Thank you.
Perfect. Start to the show. So moving on to the next one. Mr. Google's wife, Mrs. Google, she has asked, how are capital allowances claimed?
Yeah, as I
And by
mentioned,
the way,
probably.
before we do that, before you jump onto that,
Yeah.
the kind of the clue will be the fact that if you are looking to make a capital allowance claim, there is a link below this video, and all you need to do is send the form, and that will go over to Jake Ellis's team. But on the main, people shouldn't do it themselves, I would say.
It is sort of complex. Well, it can be entirely complex. So there's lots of legislation, and the revenue have a load of published manuals on the subject, and they don't really scratch the surface of the complexities. So
No.
I guess one of the ways to sort of figure out is to actually understand what you're buying it in, what you're going to do with it, I guess, and understand who you're buying from and how you sort of can protect them as you buy, or how you claim them as you go through. So what do I mean by that? You have to have a legal entitlement to claim. So you have to have those things I mentioned about. You have to have a trade, you have to have a property business, or you have to have a finished holiday-let business. You have to have the qualifying expenditures. You have to make capital, not revenue expenditure. And fundamentally, you follow the process through a bit of due diligence and a bit of legal entitlement, and then you can make a survey of the building, understand what you're claiming for, and then the result of that is to put the figures from that survey and that valuation exercise into your tax return. So what would be surveying and what would we be looking at? I'm talking about the building services. So it can be at one level down to the lowest level. Your door handle is a machine, so it qualifies for a capital allowance. So it does a bit of work. Your toilets and your wash basins, heating and lighting. So all of those things perform the building services. So those can be valued, packaged up into a value of what we call plant and machinery allowances, and then brought to save tax in your tax return. And there's specific boxes in your tax return to do so.
I mean, one of the things I often talk to you about, Jake, is when people think about capital allowances, they will often think about, well, surely I can do it myself because I can look at the items. But what I always say to people is, well, actually, you can't see in the walls, the electrical appliances on the wires and the plumbing that goes into it. That is your speciality. That's your skill set. I mean, if someone said to me, do a capital allowance, I wouldn't know where to start, to be honest.
Yeah, so there are a variety of I suppose capital allowances, it remains the most legitimate piece of sort of tax plan you can do around commercial property in the main, but there are some nuances about what does qualify and what doesn't. And in the main, I suppose the accountants we work with will, if they have a set of invoices, they'll maybe have a go and allocate the cost for allowances best they can. I suppose if you really want to maximise those points, then perhaps understand what the law is doing for you, who can carry out the survey, what the valuation be, and maximise those allowances. After all, the incentives are there for you as a capital investor to actually make. So perhaps you can go on and make some more as well. So and that's about it, really.
And typically, when we talk about capital allowances and making those claims, because you go out, inspect that building, and then a week, whatever short period of time it is, to generate a report.
Yeah.
What type of percentage do we talk about? Because I remember you doing some training with our guys talking about capital allowances. And if someone's got a commercial building or a service accommodation, what kind of percentages could you typically get on a commercial building or a service accommodation? No, I'll scrap that. Holiday let.
Yeah. Okay. Yeah. So holiday lets typically anywhere between 20 and 40% of the price consideration or the capital that you spend. If you spend £100,000, then £20,000 to £40,000 would be an allowance typically. In retail properties, so some of your clients and your listeners might want to buy a retail with uppers at the moment, maybe under the permitted developments and considerations like that. So maybe the retail would qualify around about 10 to 15%, and maybe we could look at the communal areas in the flats above if they did qualify, so around about 5%. So sort of a nice balance. So I would say 20 to 40% across the board, nearly all different types of property.
And that's 20 to 40% of the actual purchase price, ultimately. It's not just the portion of, for want of a better phrase, deposit you've put in. And that's a huge slug of money that can now sit as a legitimate expense, helping minimise your tax, potentially for 7 years forward. It's huge.
I think if everything's in your favour, then you can expect between 5 and 10% of your total capital back as a tax saving overall as cash.
Which is fabulous.
Which is a huge amount. Let's get to the next question, because there's lots of people with questions. I want to make sure. Mr. and Mrs. Google's son, Google Junior, he has asked a question. What are capital allowances and annual investment allowances, AIA, and how does that work in regards to your work?
Okay, so an annual investment allowance is a faster write down of those allowances. So until March 2023, now you're allowed to write down your allowances of up to £1 million in the first year against all of your profits, and that's pretty much it. So you get 100% write down of all of that. If you've made that profit, and you can actually write it off straight away or write it down straight away in the first year. So the good thing to know about annual investment allowances, and I guess we've done this with one of your clients recently, Simon, is that they've made that capital investment, they've had an SPV, they just got into it, they're going to be at a loss in the first year. And what we've done is we've used the claim for the annual investment allowance to give them an even bigger loss. So the moment they become profitable, they can offset that loss straight away against any profits in the future. So it doesn't seem like a big deal, because they're not really getting any cash, but actually they're really getting the cash when they really need it. So they don't write a check to the revenue. They actually just get a zero. The tax liability becomes zero or less than it would have been.
And funny enough, we did some analysis for, and I don't know whether it's that particular client, but we identified, based on their plan of approach on how they're going to grow that business, it's going to be 4, maybe 5 years before the taxman gets 1 penny out of them, which is absolutely fantastic.
Yeah, and I think that's the interesting thing when you're making capital investments. Even if you're in an existing property business, then you've got good profits, then the annual investment is really good to write down and offset the tax liability really quickly.
Yes.
And then if you run it at a loss, then it's just being understanding where the value is, and those allowances. The government have just extended the deadline for those annual investment allowances to 1 billion until March 2023 to further encourage capital investments in this sort of thing, and in plants and in other capital investments. So
yeah,
it's all sounding good.
One question I've got though is there is a time frame, isn't there, in terms of the being able to claim the annual investment allowance? So you've got to buy a property. Let's imagine you bought a property on the 1st of January to make it really easy.
Yeah.
At what point would you need to have done the capital allowances report through you at 6 Forward in order to get the AIA?
Yeah, it's in your first year of expenditure. So when you have to account for that, yeah.
Yeah, because if someone, let's talk about someone that had this property or has got service accommodation or commercial properties watching this show, and if they want to fill in that capital allowances form, the link's just below the video description. So go ahead and do that. But it doesn't mean just because they can't claim annual investment allowance, it doesn't mean they've lost capital allowance, does it? They just get a different rate.
Yeah, just get a different rate. There are 2 other rates there. So as you rightly said, Simon, there's the building services of very simply the stuff that's stuck on the walls. So and then there's the bits that are in the walls, which are commonly known as integral features. I'm sure some of my team will be cringing at some of my non-technical explanations, but in reality, you've got the main plan, which is written down at 18% a year, and you've got the special rate expenditure, which is written down at 6% a year. So the stuff in the walls, 6%, stuff on the walls, 18%.
And so broadly, what I guess we're saying, just to kind of bring it back to clients who may not be very familiar with capital allowances, that circa 40% you might be able to extract out of a let's call it residential property, or property of some nature that might be, for example, furnished holiday let.
Yeah.
You're still going to get it. It might just take you a little bit longer, because you have to almost pick at the value slowly over a number of years, rather than have it all in that first year. So the fact that you might claim it after the first year because you weren't aware, now you want to claim it, you're not going to lose out on the overall value. It just means you won't get it in one slug, you'll get it in several amounts.
Yeah, the value is exactly the same, and the relief is exactly the same. As you say, you can imagine a sort of a spike if you use annual investment allowances, or imagine that just a slowly decreasing gradient over a number of years if you don't use annual investment allowance.
Yeah.
Okay, great.
Yeah, it's a bit like having a coffee in the morning. You get that spike of caffeine, and then eventually just a winter break, and you're back to being a zombie. So just going, Steve's got a part 1 and a part 2.
Ooh,
so
okay.
Steve, it said, I'm a freeholder of a public house in London. I will be incorporating a limited company, which I'll be a director of. A lease will be created for the pub with the tenant being in the limited company. Now, that's not the question, of course. The question is, here is claim all the capital allowances expenditure for all items, including my structural modifications. So typically, it's always difficult, Stevie, to look at all the finer details. But typically, when you've got someone that owns a pub in a limited company, let's say for this matter, Jake, there's obviously capital allowances that would be claimed. You've talked about below with uppers that are residential. Pubs are no different, I wouldn't have thought. Oh, Jake's microphone's gone off.
Yeah, pubs are perfectly legitimate consideration to claim. Again, you have to have the qualifying activity, qualifying entity, qualifying spend for capital. And then really, as a landlord, not a pub landlord, but or as a freeholder or a leaseholder, then if you've got the interest in the land of that property, then you have a long lease, or you own the freehold of that property, then you can legitimately make the claim for the expenditure in the limited company. So typically, a pub may have changed hands historically, either through one of the big chains in the past. So, for example, we come across a lot of independent landlords who are trying to make a bit more of a bespoke offering in a gastropub type consideration, unique sort of fixtures, unique sort of fit-ins, ambiance, and everything else. So in general, that would be quite typical. Anything from the flooring all the way through to some of the finishes. Interesting point that Stevie makes is on the structural modifications. Historically, you weren't able to claim for structures and building elements until 2018, until October 2018, and now you can.
Hooray!
So you can, but the write down for that is 3% per year. So you can claim for everything that's on the walls, everything that's in the walls, as long as it qualifies, and then everything that's structural in nature, again, as long as it sort of qualifies and is part of the trade, but there'll be a lot of lower write down. So there are much bigger claims to be had, but you can actually look at it. I'd say on a case-by-case basis, just understanding who qualifies, where's the entitlement, where's the survey, what's the valuation, what does it look like, and go from there, really.
Very good answer.
I like that.
I do like that. I'm going to go.
Hopefully Stevie likes that.
Yes, let's hope so. So the next question is from Guy. Guy has asked the question, what's the difference between capital allowances and expenses?
Okay, that's a good one.
That's one with you, Jake.
Okay. Thanks for asking the most difficult question that's been argued about in the tax courts for 100 years. So, interesting. So I guess two things, I suppose. Your revenue expenditure is for short-term expenses. How you run your operation, how you run your pub, how you do that day to day, your ordinary repair and maintenance. You've got a rip in a chair, you replace the chair, you refurbish, that sort of thing, any painting and any small items. So that's revenue. And the capital items for the long and lasting and enduring benefits of your trade, sort of a one-off expenditure. Things that you need to acquire, proper upgrade, refurbs, full fit outs, and those sort of things. Something that might not be changed for a whole generation. So classically, these are the sort of things we see when people extend or refurbish entirely. Then the capital elements versus the revenue element is pretty much, it's very generally better. It's going to be hard to say to the revenue that your entire fit out of £1 million for your pub is actually a revenue expense, when in fact it was an expense. But if you want to replace all of the toilets on 2 floors, complete with the plumbing, arguably that would be a capital consideration. So
I think the answer was so good that one of my clients has just fainted.
You heard a bang behind us.
So you heard a bang. That was my client. By the way, I don't purposely imprison my clients. So just in case you was wondering. So just a quick one on this point, actually, because there is a capital allowances and expenses. Let's go through some items. So you mentioned toilet. That can be claimed under capital allowances.
Yeah.
What about a integrated kitchen?
Yeah, integrated kitchen. Yeah, certainly. Interesting points. There are some tricky points. So we had this conversation recently, I think, with a finished holiday let client who'd read the SDLT Act and the Capital Allowances Act, and there are some contradictions between the two.
And chattels.
Yeah, and chattels. So loose items still claim for capital allowances, but they're not fixed. So they're not fixtures. And Simon, I'm deliberately, and for everybody else who probably knows out there, I'm deliberately avoiding the technicalities for the benefit of everybody else.
We don't need to go there.
I'm not going to go there. Right?
I'm trying to make this light, Jake. Don't.
Yeah. I've actually got some juggling.
Let's go through some different items. Let's go through some different.
So if you had a fully integrated kitchen and everything was fixed, so worktop, top the cabinets, top and bottom, cooker hood, cooker, integrated dishwasher, fridge, freezer, those elements, some considerations for flooring, potentially some considerations for splashbacks, depending on the setting, not just for an FHL, but certainly in a pub. So, for example, a fitted kitchen in a pub or a restaurant kitchen would be significantly, the cooker hood in there would be interestingly huge compared to the cooker hood in your furnished holiday let, for example. So, as long as the item is fixed, then yes, is the short answer.
What about a settee?
A settee is a loose item. It's a chattel. So yes, you can claim capital allowances, but you just do it in a different way, really. So it's more of a fixture and a fitting, a furnishing, a loose item.
Okay. How about a lamp? I'd say lantern. Maybe in 1800s. A lamp on a table lamp.
A table lamp, same as a sofa, treated exactly the same way as a loose item.
It's loose. Yeah.
So if you had a pub or a restaurant with rooms or a hotel or a care home, then the divide between the loose items and fixed items would be important to distinguish.
Okay. And I think just because we had a question about what are expenses, and I think this is quite good to differentiate, because what Jake is explaining to you is that you claim these on capital allowances. The question was, well, what's the difference between expenses? So in HMRC manual, you can have an expense against your property, which is a replacement, repair, renewal. And there can be times whereby you could say, well, actually, it's either and I know that Jake and I have done this before, whereby clients have claimed things through expenses using the repair, replace, renew, which is a HMRC thing. And because of that, you can put it against your accounts, but you can't claim it twice. You can't double dip, as they say. So you have to think about, well, how do you extract this? So if you are going to go for capital allowances, you've got service accommodation or you've got a commercial building, don't go through the repair, replace, renew concept, because you just won't be able to claim as much. You could have claimed it in capital allowances anyway. So you're almost wasting your time. You may as well kind of capitalize the costs out, get someone like Jake. Again, don't forget, there's a link below this video. Make sure you click on that link to be able to put forward your capital allowances claims. But that's the better way around it, rather than go through repair, replace. If you've got a standard buy-to-let, Jake, myself, and Louise have not spoken about capital allowances buy-to-lets or HMOs. I just think we can ignore HMOs for tonight, because I don't think that capital allowances really is that all that great for HMOs, unless you've got a really super duper HMO, which is like 100 rooms. But I think you can then go for the repair, replace, renew, because if you can say, do you know what, I've replaced a carpet, or you've replaced something that was there, so therefore that will be allowed. Years ago you couldn't claim it, but now you can. If I'm going to repair a broken tile on the roof, that can be claimed. And what's the other one? Replace, renew. Yeah, if you're painting and decorating, that's renewal. So you'll be able to claim that. So standard buy-to-let, so maybe that's an easy way of thinking about it. If you've got a standard buy-to-let HMO, go through the expenses route. If you've got service covered, be careful here, Jake. Holiday let, versus commercial building, then always do capital allowances claims instead, because you can get a lot more a bang for your buck. Would you agree with that, Jake?
Yeah, I think it's a nice way of summing it up entirely. Another thing is we talked about an integrated fridge as part of a kitchen for an FHL, whereas you just replace a fridge, you just plug into the wall, then it's just a replacement item, isn't it? So that's a simple way of doing it.
So I think we've got some good questions coming through. I'm just going to go on to some more because there's quite a few coming through. So I think I've just covered guides. Let's go through now this one. It's from BK. Do capital allowances? Hi BK, by the way. Do capital allowances work for service accommodation? Now this is being interesting because I think we can have a good laugh about this, Jay.
I can see you twitching already, Jake. Twitching.
Yeah.
Okay. I've got some wine, so you're all right. So.
Yeah. In a mug as well, just to conceal the evidence. So if I buy a terrace house, for example, refurb it and then put it to a service accommodation mortgage, can I claim capital allowances? Forget that it's a terrace house; it's service accommodation. There is a huge. I mean, the capital allowances world doesn't even acknowledge service accommodation, does it? It's holiday let.
Yeah, I suppose there's a massive question, and you're right that I'd probably twitch quite a bit at this sort of thing. But I think ultimately you've got very, very few key points. So in the main, capital allowances are not allowable for residential properties and ASTs, which is why the revenue don't really like HMOs because of that, because they think it's a house share. And if you think what the revenue is up to and what they're trying to do, there's £2 trillion worth of government debt. Any sort of real excuse to sort of take that and not give that money, then it's interesting. So they are on record as denying sort of claims. So there's a whiff of we don't like residential in the marketplace, if you like, from that perspective. So when you buy a terraced house, yes, you are buying a residential property in the main, but you could be buying that terraced house that has already been operated as a holiday let already. So there are some complications. So it is a much bigger question than you think. So if I take it apart into two parts, service accommodation, yeah, you're right. The revenue doesn't recognise, or there is no sort of formal consideration for serviced accommodation in the legislation. So let's sort of unpick that. What does that mean? Service accommodation in real terms would be something like a B&B in a hotel, is how it would be interpreted by the revenue. A furnished holiday let that satisfies the three criteria of the 210 days, 105 and 31 in 155. If you satisfy those criteria, then you have a furnished holiday let business. So in sum, if you're buying a terrace house from somebody that's just selling it as a residential property, that's fine, and you can refurbish it, and you can then you can claim capital allowances when you are trading.
Perfect.
And something I recommend to a lot of our clients and all of you listeners and watchers out there, if you're not certain you understand the criteria that Jake's just described, go Google Help Sheet 253. That's Help Sheet 253 from HMRC. And it's a superb summary of the key conditions and the key hoops you're going to have to jump through if you're going to prove that the asset you are utilising truly meets the furnished holiday let standards and therefore can have capital allowances applied. So do go and look at that Help Sheet 253.
There you go.
Just one other thing on that, if you don't mind, is just that interestingly, I was chatting through with the team today about thinking this might sort of come up, I guess, is that if you already have a property business, then you can claim for capital allowances from the offset, potentially. Here,
Okay.
If you don't have a property business as an SPV, you can't claim for capital allowances from the offset. So I'm hearing some whiffs from some of the property networks and the pins and everything else that people have been told, yes, just buy an SPV, you can go and off you go. The reality is you can't claim if you've got an SPV until you're trading. But if you have got a property business already, then you can claim, and then basically you're then claiming for when you buy, and then as you rip out, but there's some things left, you claim with what's left, and then you can claim with what you're replacing as well. So it doesn't sound so bad. It's actually very positive. It's just a timing issue that SPV, no, non-SPV already trading, say you've got a property business already, and you can claim from the outset.
Yeah. And what I would always say is just, guys, the best thing to do is fill in that form below this video. There's a link there. That's going to go straight to Jake. He's going to know exactly what his job is. He's going to confirm with you whether a claim can be made or not. So the best thing to do is just look at your circumstances. Have I got a service accommodation, holiday let, or have I got a commercial building, not a HMO, not a standard buy-to-let? I know BK is trying to force it down. Can I get it if it's this size?
Go for it, BK.
No,
try.
I like a trier. I've got to say, I do like a trier.
It's about understanding.
Keep that persistence. Keep punk riding. You never know. HMRC might change their mind. But
yeah, I would just ask. I think the bottom line is, if you're buying or you're selling, then just ask the question, because there just might be something in it earlier in the game, and you just don't know, and it just isn't just as black and white. Going back to your points on complexity, you could be entitled straight off, or you might not be. And any advice perhaps to tell you that it's a one size fits all scenario isn't true. Everything's on a case by case basis. I've even asked the team to look at all the variables, and it's massive. So
yes.
Even if you just think it's talking about service accommodation, a terrace house, and an SA mortgage, that throws up a whole load of different variables as well. So just ask a question, and we'll probably tell you the answer.
Yeah. That's probably the best thing to do.
I think below is so critical.
I do think we've frightened Lee Dixon off, though. And I'm hoping that we haven't, Lee. So to claim capital allowances, is it only possible for properties under a limited company? Well, it's not. It's under personal name and limited company. So I don't need Jake to answer that, but I hope...
I think Jake did earlier, actually. Jake talked about... It's about looking at whether the asset meets the criteria for being able to claim a capital allowance. Who or what owns it matters not. It's to a degree, other than pensions, of course, Jake, and a couple of other points that you made. But it's, does that building do what it needs to allow you to claim the capital allowance? And that's the really critical thing.
I've got a couple of questions that Cal has asked, but I'm going to bypass those only because I think we've answered those in terms of integral features. So, Cal, if you're listening, hopefully you've answered those. But if not, then please do feel free to come back to it.
Or use the link below.
There are some special rules on integral features which could actually be determined based on the timeline of the ownership of the property. So there you go.
Okay.
Yeah. So one question that's come in, and it's related to what I said actually, was from Linda and Keith. Good evening, guys. It's how far back can you claim? I mean, if you've got a property that you purchased in the 1920s, I'm not saying that Linda and Keith are old, please forgive me. But if you did, how far can you go back on your capital allowance claim?
Yeah, in the main, there's no time limit. You can go back as long as the asset is owned and used, as I said a bit earlier on. However, since 2014, any commercial property that's acquired, you get 2 years generally to make the claim on the acquisition, but there's no limit on the claim for any capital expenditure in terms of refurbishment and fit out and the like. So, yeah, arguably you could actually claim for the fit out back in 1920, as long as nobody else has claimed before you.
So you oldies out there, who's managed to get onto this webinar session, don't take
that from Simon.
But you can make those claims. So let's just go to Neil had a question. So anyone, guys, if you are live, then do that. Is this the same for holiday lets? Yes, Linda, Keith, it is. Just so answer that question.
As long as they meet Help Sheet 253 conditions.
Okay, so Neil's asked a question. When converting a non-residential building, commercial for everyone else, into residential or mixed, how can we benefit from capital allowances? Now, this has been interesting, actually, because we've had several cases whereby we've worked together with clients whereby someone's got a commercial building, and I'm still not clear, and I probably never will be, Jake, to be fair, is when you can claim capital allowance. Can you claim it when it was a commercial building, convert it, and then have another claim?
Yeah, this is exactly. I mean, I think everything that we've talked about is that this is another sort of multiple question. So yes, if we had a business that already had a business that was already operating as a trade, then you can claim the moment you buy that as part of your business, because it becomes part of your trade. Okay. If it's an SPV, then you can't. It's only at the point that you convert it into residential, and only if that residential and that mixed use then qualify for allowances can you then claim that as part of your trade. And that's pretty much it.
Well, what happens though if you have got these? Let's say you've got a limited company that's properties, as in it's already owned 4 properties.
Yeah.
It buys a fifth that is a commercial building, which you then convert. Could you make a claim on it whilst it's a commercial building in your portfolio?
Yes, in principle, yeah.
Okay. So again, anyone listening to this show and thinking, well, actually, there's a few things I'm doing to convert it from commercial to resi. Again, nothing is, we will never say on the show that everything is concrete, black and white. It really does matter on a case-by-case basis. But the good thing about this show, and thanks to Jake for coming on this show as well, is it gives you that sense of awareness of what you can do. My favourite saying is, you don't know what you don't know. And hopefully this show is giving you some ideas. And if it has given you some ideas, by the way, I've only noticed that our YouTube channel has only got 1 like on it. How shameful is this? That I've only got to see 1 like. I want to see that
and
one.
And we've thrown lots of pantomime things at you already, people.
Stacks. So I want to see those thumb. In fact, I'm going on strike unless I see that thumb going up by counts of 10s.
If he starts to sing, that's when everyone has to worry.
Yes, absolutely. Absolutely. So hopefully that's answered that question. I've got another one, which is the same kind of thing. I don't want to ask that one at all. Can capital assets be claimed? So, Sushila, I think you've asked that question about, can you convert buy-to-let SA? I think we've covered that to a good degree now, if I'm honest. But there have been other questions. We're going to have a look to see if we can do that. So we talked about losses. So I think we can do that. And is capital allowances depreciate? Let's just put that in there, because I'd be interested to see what you think about this. Because years gone by, why is that not showing? There it is. So Google's Google Dog is asked a question: is capital allowances depreciation? And what that means is, years ago, you could say that I've got a building, and over a number of years, I'll get a reduction in my profits because of the depreciation. You still get that in the United States, by the way. So if you are thinking about buying real estate property in the United States, trust me, there are so many more tax advantages over there right now. The pound is very good for the dollar, 136. You can't get better than that. You can get a nice kind of service accommodation over there. It is called service accommodation over there. In state of Florida, you could buy something nice for about $250,000, $300,000. We can hook you up with a good realtor over there and be placed in the sun. I'm getting daggers now from Louise. So the question is, coming back to UK, is capital allowances depreciation? Jake, take it away with your answer.
Capital allowances is tax depreciation. So you don't get depreciation for capital above the line. So basically you add in the allowance after the bottom line, really, and you reduce your tax liability and not your profit, and that's it. So if you have £100,000 of profit, your tax liability in a company would be 19% or 20 or 40% as an individual taxpayer. Then basically, if you've got £100,000 of allowances, your profit's still 100,000, but your tax liability is 0. That's it.
Happy days.
Happy days. Well, I'm going to let you go, Jake. I think this has been amazing. We've got a couple of questions that's not capital allowances related, but I've put you through the mill. I think it's fair to say the questions.
On a Wednesday night, Jake.
Thank you very much. It's a real pleasure. Thank you very much for
mine. Is that right?
No worries. But yeah, if anybody's got any questions at any time, just ask. I think in reality, if people are making this level of capital investment, then really just get it right and just look after their investments from the offset and just look after it from the offset. So if you buy and sell in, make sure you get things in the heads of terms if you're buying from a commercial entity, or make sure you know what you're going to get from the outset. And it is worth looking at for cash flow and for tax saving purposes. So every time, just ask the question.
So everyone, the link below is there for you. Jake and his team are ready and raring to help you. Capital allowance is relatively straightforward to understand. Hopefully you've got quite a strong gist of what it is tonight, but they are still quite complex. There's still a lot of intricacies, and you need to make sure you don't trip yourself up in the way that you go about claiming them, so that they can't be clawed back or taken away from you. And Jake and his team are absolute godsends in terms of helping you make sure you follow the rules and get every last drop of money back that you are entitled to. So use that link, people.
Absolutely. Jake, thank you ever so much.
Thank you both. It's been a pleasure as always, and good luck with the rest of it.
Thank you very much, Jake.
Thank you.
Cheers.
Bye.
Bye.
Bye-bye.
So Jake has disappeared. So
Jake has left the building.
The technology has worked. So I'm totally grateful for that. Obviously, this show is for an hour. It's pretty much coming up to the hour already, which is absolutely amazing.
How has that time gone?
We do need to change the structure though, and I want to make an announcement for this. Okay. All right. So the idea behind this show is typically to get your tax questions answered. What I do realize is that you guys have been so amazing. To point different types of questions that not capital allowances to us, but clearly we want to focus on capital allowances. It was a big subject that we want to get across for the year, but we just didn't have time for the other stuff.
Yes.
So what I think we're going to do is have our guest on the half hour, and then we're going to go through for the full hour. So we're going to have a 90-minute show, if that's all right with you.
As long as it's all right with you guys.
So that from next month, we'll do a 90-minute show going forward.
Right.
So the first half an hour will be us talking through your questions, not related to the subject matter. Then we're going to get our guest speaker on. And then for the full hour, we'll go through their questions as well. So hopefully we can do that in a new format, because I just didn't think there was so much content going to be given on capital allowances. But you guys have been absolutely amazing with your questions, so I do appreciate that, and hopefully you got some insight. But like I say, the form is below this video, so just get it in there. There is so much opportunity, so much tax rebates to be had with capital allowances. I've known Jake 4 or 5 years at least, and it's amazing what he's done for some of our clients. We are not specialists in this field, okay, so I'll be straight up about that. He's educated our team only 2 months ago.
Well, we're specialists in applying those allowances to your benefit, but in terms of making sure that you've captured every last drop of capital allowances available and valued them up correctly for your building with specialist survey expertise, that's where Jake and his team come along and really make the difference for you.
So thank you ever so much for joining us tonight. I do feel guilty that you've been asking questions that's not related to capital allowances. But please come back for next month's show. We will be another guest speaker. I think we're going to go for stamp duty and land tax specialist. If I can get David Hanna on the show.
David.
If you're listening out there, David, I know I'm seeing you next Wednesday. I'm going to be hunting you down again anyway. We'll catch up on that. But thank you for joining for tonight. And next month, it will be 90 minutes. And
hopefully you'll have more time to join us for that too, because you won't be filing your self-assessment tax returns, will you, people?
They might be doing their 1040 tax returns.
Well, okay, for their UK tax returns, though, it'll all be done and dusted if it isn't already.
For you Americans, though, you better be
You're getting started.
working hard.
Bless you.
Absolutely. All right, guys. Have a great evening. See you again soon.
Bye-bye.